In this video, I want to bring your attention to corn. Now, corn has been coming through this nice, big, long drop. I mean, it's a big, nasty drop. But let's think about corn for a minute. We're coming into the harvest time, and if you ask a farmer when he's going to have the most crop or the most corn on hand, it's going to be at harvest. And so it's very common, it's very traditional to realize, know, and understand that the prices of corn drop at harvest time. Now, if we come back here and I want to show you something, and if we won't note the date, today is August 30th. And I'm going to go to a weekly chart. And if we look at this weekly chart, this is today's weekly bar. All right. Now, if we go back, this is the August 27th weekly bar. Now, if we go back to this low, clear back here, last year, this was the August weekly bar as well, the last week of the August time frame. So these are the two same bars, all right, from last year in August, the end of August, to this year at the end of August. So if this was the last or the end of the August and the market started to rally up out of here right after that, and this is the same time frame, why couldn't we anticipate or expect this market to start to rally back up out of here at the same time? It's just a little long shot, right? I mean, you're throwing darts, but nonetheless, this is kind of an idea that we're going off of on the seasonal pattern of this market, that maybe this is the low. Now, I've talked to some farmers, so not only is it the fact that this market was down here at $3 per bushel at the low of this time, and right now, the low is at about $3.32 per bushel. And I've talked to some farmers and they're saying, you know what, Lan, at $3.50 a bushel, we're not making any money. It was just simply, it costs $3.50 a bushel just to produce this stuff. So who's driving the prices down this low? It's the international markets. It's also these great big huge giant conglomerates that can, produce corn at a little bit lower rate than the general small farmer. So we do have a little bit of a variance in there between the cost of what it costs for some people versus other people. But nonetheless, we're getting down into a very painful low price. And since this is the same low as we received last year at this time, why can't we figure that this market might start rallying up out of here? And if we draw a common number in here, you can see this was also a very common number right here, a low point. We've come down, we've touched that same price where the market came back, retraced, and started to rally once again. There's no reason to think that maybe there's not a chance for this thing to rally, but there's always that downside potential. So there's always that, oh, but what if it does go down and continues down lower, Lan? What if it comes clear down here to $3 per bushel? And that's a lot of money between there. I don't want to take that risk. That's a $1,575 move. If it breaks this area of support, the next level of support is that very bottom price at $3 per bushel. Well, let's come in here and let's play some games. All right, let's come in and do some technical analysis. We're going to come in here and look at the daily chart. Now, here's the daily chart. Again, coming down, dropping. This is the end of the week. But let's go down to a shorter term time frame. Let's go down to the range bar chart time frame. Now, here's the range bar chart. Now, this is what we consider a day trading chart, right? It's the smallest time frame we can really go and trade against. And this is the chart time frame that we use when we want to day trade. But when you're day trading, or when you're down on this very small time frame on corn, we're not actually day trading, because let me show you something. Just from this point here, let's just do a dollar run from this arrow on the bulls and bears down through this bullish trend. You can see that's about a $1,375 move. Now, of course, that doesn't represent commissions and fees. That's just the distance from this location to this location in trend. Now, how long did that take? Let's go in here and count the bars. Well, if we come in here and count the bars, that was 15 days. All right, 15 days. Now, this is not a day trading time frame, although it's a day trading price chart. All right, so we went over a 15-day period of time. But over that 15-day period of time, let's look at this from a technical standpoint. All right, we got our first drive there, we got our counter drive, we got our second drive here, we got our counter drive, and we got our third drive here. So what is that? That's an Elliott wave, right? So if we come in here and we count those off, that's X. Of course, the bulls and bears is the one that's telling us where this thing breaks. So we're going to count right at the bulls and bears. X, 1, 2. Here's the next break right in here. So that would be 3, 4, and we're waiting for the next break, which is clear down here, which would be the fifth wave. All right, so then we'd see this ABC. So this is what we're kind of anticipating out here in the future on a smaller term time frame. Now, not necessarily in one day, obviously. This has taken 15 days to make this downtrend in the Elliott wave. This ABC pattern is going to take probably another week or two, right? So if we take a look at this retracement, where do we anticipate it going to? From the top to the bottom of that trend, back to just 50% would be where we would anticipate, right, on the initial movement, back to 50, maybe 61.8. And if we did that, from where it's just trading right now back to 50% would be about a $775 move. Now, there's several ways that we could attack this market. With the information that we've got now, we could very simply come in here and we could just drop an order, right? We could buy one, or we could buy three, or however we wanted to do this, and we could just trail down on the bulls and bears blue light system, wait for the intercept, and take our long positions on and off as we go through the next strategy on the very short-term time frame. Now, that's a very viable method of trading this, because we are at the 3-wave drive to the bottom, and we are looking for that retracement. So there's nothing wrong with that strategy. But we could do something a little bit more conservative, considering the fact that if we come down here and we take into consideration that we have this this mark down here, this $3 per bushel area of support that we're afraid of, that this market might actually come down there. How could we protect ourselves against that? Now, if we come into the daily chart, one way we can do that is with options. Now, let me show you this little trick with options. We could come in here and we could just buy an option spread. First thing we could do is we could come in here and price out a call option. We see what a call option would cost if we wanted to take a long position. Now, if we look at this strike price list here, you can see these are the calls and puts, both intertwined in here. So I'm going to come in here and just go out of the money and switch that over to just calls above and just puts below, because we're just going to buy. And so we're going to come in here, and how much would a call option cost at the money? Well, it would cost me, with 23 days left to go, about $256. Well, if I was to buy that same put option, which is about 245 put, about $325. So you can see we're right around $300 for buying a call right around the area of the strike price, about the current selling and buying price. Now, if we went out and did a little bit longer time frame, let's come out here to the next one. This goes from 23. Let's drop down past all these, and Track and Trade says 58 days has some good volume in it. So let's go in and look at that one. And notice that an at the money put is $493, a 350 call is $425. So what we could do is we could come in here and we could do ourselves a very simple little spread. Why don't we come in and go back to the 23-day option, and we're going to buy ourselves. Now, we realize that time decay is going to go very fast, but that's okay, because we're actually bullish this market, right? So let's buy ourselves a little insurance premium. And we're going to pay about $300 for that. So let's come in here and we're going to buy a put option. So I'm going to buy a put, thinking that the market has some downside potential. And I should know within the next 23 days, right, whether this is working for me. So I'm going to buy this option in here. It's $331, and I'm going to just go ahead and I'm going to buy that one. Now, I've only got 23 days left, but again, this is just an insurance policy against some downside potential. Okay, now the next thing I want to do is I want to come in here and I want to buy a call option. Now, I want to buy a call option at the exact same strike price, that 345 strike, that $3.45 put. So same place I bought the put. So now I'm going to come in here, I'm going to buy a call, and I'm going to drag that down on the screen. Now notice that when you have on-screen drag and drop orders and you want to put something right on top of it, the text kind of goes on top of it. That's one of the downfalls of having drag and drop orders, but that's not a problem, because all we have to do is we drag that to the exact same place, click our mouse, and it pulls up this dialog box, which then shows you all the information anyway. So you don't really need to see what's down here on the screen at this point, because you can see it right here. And now what we're doing is this $3.45% call, or $3.45 call, which is the exact same price that we put the put, one right on top of the other, is $543. It's a little bit more, right, because we got more time in it. We got more time value left. Time to expiration is 58 days. So I'm going to pay a little bit more for the call option, anticipating that we're going to get a reversal at this point, but hedging my bet, saying, you know what, I want some insurance in case the market goes down. That's why I bought that put. So now I'm going to come in here, I'm just going to buy one, and I'm going to pay for that one. And now you can see they're laying over the top of each other, and you say, okay, well, very simply drag up the accounting window, and we can see both of those in here as open positions, and we can see all the pertinent information that we need right here in the window. We can see that this option that we bought is the put option, a 345 put on corn, has 23 days till expiration, and we paid $331 for it. And the 345 put a call that we bought is right here, and we paid $543 for it. Now we can watch these two. Now think about this, because the lesson here is that an option has the right but not the obligation to buy the underlying futures, right? The maximum amount of money you can lose when you buy an option is the amount of money you paid for it, the premium, $331 on the put option, $543 on the call option. Now, if you think about this, the market only has to move a very small amount before you've covered your cost of that paying for that insurance policy. So if we come in here and let's blow this up a little bit, and I'm going to zoom in a little bit more, and let's say we paid $300 for this option. Let's say it only has to go roughly that far. The market only has to go basically that far to pay for that option, right? Before we've made as much money on one that we've lost on the other, to kind of cover ourselves. So we're going to make as much money on the one option that we're losing on the other, no matter which direction the market goes. But as soon as the market exceeds the amount of money of loss as the premium of the underlying option, or the option that we paid for, as soon as the underlying market moves far enough that it's paid for or lost the amount of money of the premium, we can't lose anymore. But yet, because an option has limited loss and unlimited profit potential, we can then continue with the option that's moving in our favor, making as much money as we want to, whereas the cost of the premium has stopped losing money once we've reached our break-even point. So this is kind of a neat little strategy. It's a neat little trick, and if you would like a little bit more information about how to trade options, just let me know. My email address is lhturner@tradementors.com. I'd be happy to send you some more information on my futures options trading strategies.